Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, March 22nd, 2001. It's about 10 o'clock Eastern Time as I'm starting the video. Wanted to wait to see how the markets traded after the open today before getting this out. So we'll do a quick update and mostly updates on what I've been focused on lately, the major indexes, crude oil, gold, things like that, and a couple new charts. I had a good question put to me about gold under in the comments under Friday's last post. I'll get to that and show you again one of the reasons that I think it's a good time to be long gold, or at least why I am. All right, starting out here, NASDAQ 100, quick update. Primary uptrend line off the March lows broken, just as it has been in SPY. We've been walking lower. Markets has not experienced. It hasn't experienced any waterfall type or impulsive selling yet, but we are in correction mode. Correction mode just simply being that the Nasdaq fell, the Nasdaq 100 over, I think it was a little over 12%, 12, 13%, and it's been stair-stepping lower. We've also seen some sector rotation. So far up to this point, it's been mostly the tech stocks, and I'm going to get to that in a second real quick. We're going to talk on sectors. So today we're up 1.3%. Doesn't feel good if you're short, feels good if you're long, but again, from this point here, the bears have won. They've taken the market down. They've taken it down 12%, and it's still, when you look at the, you zoom in, it has all the makings of a near-term downtrend. The million-dollar question: is that over? Certainly, a 12% correction is enough to, reset excessive bullish sentiment and, low short interest, things like that. Suck in some bears, give the energy, or shorts, I should say, give the energy for next squeeze and move to new highs. But then again, based on the scope of these divergences in the extremes that we hit on so many of the indicators that I covered for the weeks to months leading up to that top, there's certainly the potential for more downside as well. So it's like I keep saying, it's anybody's game. It's a battle between bulls and bears here. My thoughts haven't changed. I don't have a very super strong convictions on where the stock market's headed from here, but there's levels that will tilt my hat. I'm still leaning towards another thrust down to the 283 level. And as I said, on QQQ at least, watching this 324.65 level. We had, that was the top of the trading range recently. We kissed it twice last week. It's resistance. We were rejected back down to the bottom of that zone. I'm referring to this zone right here, or this trading range, and that's support. And they stepped in again where the buyers should have on a pullback to support. So it's that simple. To me, it's nothing but noise as long as we're in between in this trading range. And I do believe that the direction of the next tradable trend, swing tradable trend, where you can take a position and hold it for at least a few days, if not a few weeks or more, will likely be determined on which way this range resolves. Again, that's about we'll call it 325 down to about 310. So let's see what happens there. And targets, again, besides the 283 level, if you can see on this chart, I have my 200 days tuned up. There's the 200-day simple moving average in blue right here, and the 200-day exponential moving average. Those are big levels that traders often watch on QQQ, bullish when it's above, bearish when it's below, and they also act as those moving averages, support and resistance, and they come in perfectly together right now, which is what I really like about it. And the way I see it, we haven't visited those levels in a long time. We broke them here and we're well above them. And if you go back in time, a long period of time, you'll see every now and then you come back during a strong trend, you come back to check them from above and they act as support. In a strong downtrend or bear market, you come back to check them from below and they often act as resistance until taken out. And so to me, it's somewhat of a magnet. I still think we'll probably come down through there. And my expectations, if we do, because once we get down here, if we do undercut that 297 or get anywhere close to it, that's where I expect a pretty swift drop, impulsive selling. And again, this is a micro call. Most people aren't going to make calls this precise. I think we'll slice down through the 200s intraday or maybe even intra-week, come and hit my 283 support, and then park the week or day, maybe a couple days trade on those 200s, and that may be it. We'll see from there if that's the end of the correction. It's going to feel, if that happens, I'll tell you right now, it's going to feel damn bearish. You're going to want to be shorting at that point if you're not already short. And if you're long, you're not going to be happy about it. So, but again, that's usually when you feel that bearish, like you did right here. That's when you want to be covering and going long or closing your shorts, like when we hit that first target there of 297. And of course, maybe none of that comes to fruition. Maybe we just do this, and then that's going to change things. And so that's why I like to mix it up. So we're going to go over some other trade ideas and securities here in just a second. But let me do an update on the futures, NQ futures, NASDAQ 100. Perfect tag almost at that 12,704 support level, pretty good support. And again, you can see the things here: divergent high, catalyst for the correction. There's that 13 or so% drop. Put in a divergent low, positive divergence down here at the low, catalyst for reversal. And at the same time, you don't see it here, but we hit that price target on QQQ. So we were big time support on the daily chart while you had 60-minute positive divergences, bullish divergence on the 60-minute charts of the futures. And that's why I watch different time frames. So it's all the better when you fall down to a support level on the daily chart if you have this 60-minute divergence, or if you break a trend line or support or on the daily chart, if you had divergence up here just before that trend line break, which we did on the 60-minute chart, and we also had divergence on the daily. So there it is. And then from there we had a counter trend rally. Put in a divergent high, fell just shy of that 13,342.50-ish. We'll call it 13,343 resistance, and broke that bearish rising wedge, back tested, hit that support. That's where we're at. So it's kind of, again, it's noise if you look at it step back. But what we can say, it's still a near-term downtrend. If we turn down here and take out that recent low, that's going to keep that trend intact, and it'll morph into more of a intermediate term downtrend at that point. There's no hard definition what defines short or intermediate term, but typically short term, it's a trend I'm looking at in days or maybe just a few weeks. Intermediate, a few weeks to maybe a couple months, and then longer term are your multi-month trends. So, long term, the stock market's still in a bullish trend. Okay, back to QQQ. Let's go to IWM, and then I'll get to SPY, and then we're going to move on to gold and oil and wrap it up. It won't be a long video. IWM, small cap ETF, Russell 2000. There's a lot of lines on this chart, but the most important lines, in my opinion, are this one. Put in nice negative divergence. You can see it a lot better when we zoom in here. We've been building divergence on the small caps, but it started to get really steep right there. You can see the indicators really dropping off, meaning that the rally was losing steam, losing momentum. That's what divergence is all about. When prices negative divergence, or when prices continue to go up but your indicators start to make lower lows and prices are making higher highs, that's negative divergence, and that often portends or precedes a trend change, a correction. And so far that's been the case, but not much. We're down. It's interesting. Today the small caps are down almost 1%, and yet the NASDAQ 100 is up over 1%. You don't see that often. And there it is. So that's it. There's a lot of lines here, but this is the one I'm targeting. There's your primary uptrend line off the March lows, which the S&P 500 and NASDAQ 100 have already broken at and are trading below. Small caps, again, to me, that's a minimum target. From here, and also I have nice support, right? It comes in together around 205. So I've covered that many times, and so far again today, this is what it looks like on the futures. If you're trading RTY or M2K, RTY, if it's too big of a contract size due to the leverage, M2K is going to trade at these same prices that I give you on this RTY chart. You just have a smaller leverage factor. So there it is, walking its way down, hit my first target right here the other day, and it's been bouncing, testing that first target, and we're right on it now. So if and when that goes, we do have a spike down. We spiked down below it there, but I think once we take it out again, it's going to open the door down to move my second target. And so, as I said last week, I think there's a little more meat on the bone right now on a small cap short trade than there is on QQQ, because I've already gotten a good deal of the correction I was looking for on QQQ. I think there's more downside. And the big one is going to be SPY, the S&P 500. That's what we're watching. As I've talked about lately, this correction's been almost exclusively tech, largely tech. S&P 500 holding up, with the dropped a lot less than QQQ, and when it rallied, it went on to make marginal new high, where QQQ, remember, the Nasdaq 100, not even close to taking out the previous high, and so that shows you the weighting and the impact those big tech stocks have. So, as I said, you can look at it glass half full, say, oh, Randy, that's, and I'll acknowledge it. Possibly healthy sector rotation. Tech stocks, have been leading the market for many months and many years, and sometimes you get rotation out of tech and people are buying into other things, call it the COVID trade, buying hotels and cruise liners and, and energy stocks. And maybe we'll see its sector rotation. But on the flip side, you want to do the glass half empty bearish scenario. You say, look, when tech breaks, the market breaks. These are the market leaders, and not a good sign. So what I'm watching is for the other sectors. Now let me show you something here. So here's the S&P 500 up today. Because why? Because tech is up. Tech is again by far the largest component of the S&P 500 at about a quarter or 1/4 of weighting, even though there's 11 sectors in there. And now we take a look. We couple have turned green here, but these two, XLP and XLV, were a negative earlier. But you can, so earlier today, right before I started the video, the vast majority of sectors were down. And I don't know if you can make these numbers out, but I'll tell you. You can see here the ones I've been just in the last couple days most bearish on. From about a week or so ago, XLE energy, and of course that's down 1.5% today. And then I give you a sell signal on the financials, that's XLF, and they're down 1.3. So it is, you can trade this. It's become more of a trader's market, where for many months we were in a very broad-based rally, meaning most stocks and sectors were going up, and it didn't matter what you bought, throw a dart, and everything was going up. Right now, if you're nimble enough, you can trade the be long the most bullish sectors. XLK, like I said, had a big correction right down to that 297 support target, and it's been strong since, outperforming. But on Friday, I think it was Friday, we broke down XLF, the financials, either Thursday or Friday, broke down, and so they're continuing lower. So if anything, you want to be short the financials, short energy. I gave a pretty good case of why to be short, and that's what's down today. Now the market's up because again, doesn't matter really how much XLE, what it does, because although it used to be a very big weighting in the S&P 500 years back, when Exxon Mobil and stocks like that were the big kings, it is now taken second or third seat to tech. And so that's why the market's up today. But as I'm showing you here, the majority of sectors are actually down. 1, 2, 3, 4, 5, 6, and these two are virtually flat. So really, and these two up 0.58, 0.33, and tech up 1. So really, it's all tech today, putting the markets, giving you a guise of a strong market, but the majority of stocks are down. Okay, and remember, one day doesn't make a trend, so I'm not, I don't read too much into this. Although if we day after day we continue to see more downside in the financials, in the energy, and it spills over into some other sectors, then we're going to have a true broad-based sell-off. So far, again, to reiterate, it's been more of a correction in tech. It's certainly a tradable, very, and that's where I was focused, and that's where I was short, the Nasdaq 100. But if we get a lot of these sectors start to break, then you're going to have a broad-based sell-off. So there's the SPY, big level right here. Well, not a huge support level. It's minor support, but it needs to get taken out to get another leg down. It's about 388 or 387 right there. You can see it was support there. That's what I'm looking at. Big divergence. And again, I'm going to talk on this in a second in gold. This is not the be-all, end-all. Divergences are a very big part of my analysis. I like to use divergence to identify potential inflection points in a security. Inflection points, whether they're near-term or short-term. That's where you have a trend change. When I start looking at the weekly charts and the daily charts, and you see big divergences, then I'm looking for not just a 5 to 10% pullback or correction, something like these. These were identified and traded off the 60-minute chart, these two big corrections we had here, or not big, but decent corrections. And now, back then we didn't have negative divergence on the daily or weekly, and now we have it. Which again sets the stage for a much bigger drop. And that goes against the vast majority of pundits that I hear out there. Just about the consensus seems to me to be just almost scarily one-sided bullish that COVID's behind us, the vaccines are working great, economy is coming back online, you've got a super easy Fed. I mean, fundamentally, I cannot make an argument to any of that. We have the easiest Fed I've ever seen, to the point where I think Powell is actually, whatever, let's just say, too easy, in my opinion, for what's going on right now in the stock market and the economy. But again, this is the charts. That's what they're telling me. And again, these divergences are not be-all, end-all. They can be taken out and negated. In other words, you just go up and you burn through them if there's just strong buying pressure. All right, let's move on and just look at a couple of those sectors. So here's, where did it go? XLK, again, to talk on that. All right, so here's what we need to see or watch to determine where the broad market may go. XLK has some pretty big support right here. And so you can see we took out the primary trend line off the March lows right there. There was our breakdown. That was our sell signal. That started a correction, which again, based on the charts and the scope of these divergences, I believe there's more to come. That's what the charts would indicate to me. Again, just putting fundamentals aside, this is what it's saying. We had divergence back there before that big 36% drop into the March lows, and we have big divergence right now, and we've only had in the S&P 500 a drop of about 9-10%. So, and I'm sorry, that's XLK, yeah. Where was it? Yeah, about 10%. So the Q's dropped a little bit more than XLK, but there it is. A big level that I'm watching right now. Why? Because that was this major reaction high right here. We came up a couple times, tried to test it, couldn't do it. Finally broke out. And then back tested, and we just back tested again. So bulls want to see this and may get that. Bears want to see this and may also get that. So that's why I'm watching those levels. It's two lines together, lower of which is about 125.40 or so. Call it 125 if you want. That's a level to watch. So if you are bullish and you like tech, you can go long right here. You're really close to that level. Set the stop somewhat below. You've got your 200-day moving averages just below as well, so you could put a pretty wide stop. If you think there's 30+% upside in this market, you have minimal downside if you put your stops strategically below those support levels. And likewise, if you're a bear, same thing. You can be short or stay short if you're short now with stops somewhat above the recent highs. And again, watch everything together. Things I'm looking for, the PPO, it's down below the zero line. If we start to move lower, it's going to reinforce the fact that this is the early stages of probably a much larger correction with more downside to come. So that's tech. Let me just go over the other sectors so I can keep to my word that this video won't go too long. XLY, this is consumer discretionary, and look, you can see this perfect kiss right there. There's those 200 days, right? The red and blue line, the 200-day exponential and simple moving average. And we came down and kissed them right there and bounced up so far. There's your lines, but when you look at it this way from a support resistance perspective, that's the trend line that I like. It fits better than any trend line off the March lows. Why? Because you have a lot of reactions there. A bunch of reactions back here, another reaction there, another reaction there, and then boom, we broke it, hit the 200s. And so to me, this looks like the first leg down in a correction. Corrections are usually at least A, B, C. A, B, kickback rally, a counter trend rally, which also came in close to back testing. It didn't make a full back test, close enough. And C, that would take us down here to about that 142 level. So this is XLY. This is a big weighting in the S&P 500, about 10%. Still less than half of what the tech sector is. And you can see here the big names there. If you can't make it out, as of recently, it's about 21% Amazon and 13% Tesla. So we're going to watch those two, and they will determine the fate of this sector in the S&P 500, the consumer discretionary sector, which again is one of the largest sectors. And then finally, we're not going to go through them all. XLC. XLC is, to me, the strongest looking sector in the S&P 500 right now. There's your uptrend line off the March lows, not even close to being violated at this time. We're above it right now and way above the 200-day moving averages, but you have this big divergence that continues to build like everything else. Doesn't guarantee that it's going to play out, but indicates that if it does, and we get a sell signal, that's what I'm looking for. The market's not going to drop much unless all of these sectors break down. That's why I'm doing this. Tech already broke down. That's why you need to see tech, communications, consumer discretionary, industrials. Those guys need to go. And so there's one that's still above trend as of now. But this is all about two stocks. This sector, which again is one of the largest in the S&P 500, is simply two stocks. Facebook and Alphabet. I don't know if you can see my numbers here. The sector again is one of the largest, I think the third largest, but between Facebook, which is over 21% of that sector, here's the sector ETF, and Alphabet, those two companies alone comprise, as of recently, actually I haven't updated this in a while, I need to update that, but back then it was 44%, so basically two stocks made up half of the returns of this sector. And I've done extensive analysis on those lately, but let me just go over to those now, since I'm not going to go deep into every thing. But here we are. Facebook, FB, has been in this multi-month trading range for a long time, all the way going back to July of last year. Boom, 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 and now boom, right at the top of the trading range. So we're at a pretty critical point. This one stock won't determine where the market goes, but if you see a lot of these FANGs start to break above those recent trading ranges, that's bullish. As of now, the MO has been rallies to the top of the range, the stock gets rejected and goes down, and usually once it hits the top of the range, it works its way back down towards the bottom. So this is it. This week we could see, I don't know if it'll be the week, but I can tell you right now, here's a stock to watch. If it breaks out and can hold that and build on those gains, bullish. Otherwise, as I like to say, resistance is resistance unless taken out. And the MO has been short rallies to the top of the range. And if we go back down, sooner or later, this range is going to break one way or the other. So if you go to the bottom of the range, yeah, you can maybe game another long, close shorts and rally back up, but it's going to increase the odds. I think each time you hit either the top or the bottom from this point, you're increasing the odds you're going to break out finally. So if we do get rejected here, look for that. If we do break out, you need to see some of the other market leaders also breaking out, because if Facebook's the only one that breaks above resistance and the rest of the FANGs are all running into or can't get back to resistance, and they break support, then that'll probably prove to be a whipsaw signal like this right here. Okay, so that's Facebook, and then remember the other one was Alphabet. There's a couple share classes, but this thing is sitting on a ledge, a shelf. I mean, look at this support level, about 205, 2005 on Class A shares, GOGL. Just look at that. It's a big gap right here. It was an earnings-induced gap. Very technically significant. The gap has been tested almost every day now, going back to February 23rd. So you can see right here, going back, what is that, 27 days, test. So say what you want about that level. You cannot argue that is not a big support level. So if it breaks, nothing but bearish, other than a whipsaw. That market's prone to whipsaw signals. But if it breaks and it's impulsive and you get a solid close, that's going to be bearish. Otherwise, if it holds, and again, here's the thing, you might have a different view of where the market's going than me, and if you're bullish, that is a golden long opportunity. I don't like it because of everything else I'm seeing in the market, but if I were to go long Alphabet right now, I could make a case and go long with a stop somewhat below. Somewhat is relative to how far you think the stock's going to go. All I can say is this is good support right there, and it's objective to go long. Likewise, if you're bearish, you don't go short right now on top of support. You wait for a break of support, then you put your stop just above that broken support level, which should act as resistance, and give it a little room. That's what the market does. And if you look at it this way too, if you want to also look for levels to trade Alphabet, here's a trading range right there. Box it in like that. That's your multi-month range. Every time you get to the top of it, the stock's been rejected. Every time it gets to the bottom, it bounces. So there it is. That's why I'm doing these videos. I'm just seeing there's so much right now in the charts and a lot of these leaders, and we can certainly go either way. And if we start, more and more stocks break this way, at least for the very near term and intermediate term, that's going to be nothing but bullish. And likewise, if they start to all go this way, that's going to be bearish and open the door for another leg down. Okay, and back to the sectors of the S&P 500. I'm not going to cover them all. Just now showing you those that are holding up so far, and then those that have broken down. There's XLF. That was the sell signal you got on Friday right there, and so far so good. This is what you want to see. That could have proved to have been a whipsaw, but so far it's not. The fact we're down today and down 1.5%. That's an impulsive sell-off, helps to give you an additional check mark. If you shorted on Friday, but maybe it was a weekend, so you didn't take a full position, you can up that position today, I think, because the odds are that we're going to hit at least my first target of 32.83 have sharply risen today with that additional downside. And again, this talks about the broad market as a whole. Here's a sector now that has just broken down. That doesn't help the case for new highs. The financials are going to put some a little downward pressure on the rest of the market. Overall, again, the S&P's up today because of the tech weighting. You can look at RSP, which is the equal weighted ETF for the S&P 500, and guess what? It's down 0.7% versus the SPY being up. That's the impact that tech has right there. So when you strip out the heavy weighting of technology and give all the 500 companies in the S&P 500 an equal weighting, you're down. And that's what I was talking about. Breadth being down, the majority of sectors down today. And then finally, of sectors, we also have the XLE, and that one I really liked a week or so ago here at resistance. If my lines populate 53.61, roll it back. Big resistance level. It was big support for a long time. Support. Broke that support and had a very impulsive waterfall sell-off, and this is the first back test of that broken support, again, there was your opportunity. We had 1, 2, 3, 4, 5, 6 days, 6 opportunities to short energy stocks with a stop somewhat above, and so far so good. Remember, this one tends to not fall as much as XOP and XES, but still down 10%, and not even to my first target yet of about 47. So, and then XOP, you get more bang for your buck, coming up on the first support level, but already down about 12% or so. And then XES, also same thing, down about 17-18% so far at the first target. So if you just wanted a quick swing trade and you took SCX as a short, you made 16, 17, 18%. You can cover here, or if you believe there's more downside, which I think there might be, you can try to ride out any potential counter trend bounces. We don't have to bounce. It just means the odds that for a reaction are elevated right now because we're at support on both XOP and XES. And so whether we get a reaction or not, I still think this one's coming back down to about 47.75, and that would be so we're only about halfway there looking at it this way. Okay, let's talk gold now. So the question that was put to me, I answered it this morning. You could go see that answer. I was under Friday's post, the last post. Hey Randy, I've been following for years. Gold didn't have divergence at the low when we hit the 158 level. Why are you bullish on it? Well, there were several times back here I was calling for a top, mentioned exiting all my long-term positions in gold and the miners because I expected a big resistance. So again, the case was made where long-term resistance on gold and GDX and silver, all of them at major resistance, overbought. In some cases, we might have had divergences on some time frames. And at that point in time, identified pullback target, support levels, and this was my max target back then. I believe stating as max target that if I didn't know if we'd get that far down, but if we got there, that's where I'd be really, interested in going, loading up back into gold pretty heavy. This was a scale in buy zone back here to start scaling in for long-term positions, and this is more of a hard buy. So that was called a soft buy, hard buy. Okay, why? Well, mainly because it's big resistance. Big support. And I believe overall, based on the technicals, not just that I'm a gold bug. You guys know me. I've had probably over the years, as many short trades on gold, silver, and the mining stocks as I have long. So I am far from a gold bug. Not married to anything on it. Times I'm bullish, times I'm bearish. And And just looking at the long-term charts, when I go back on gold, that tells me that we're likely in a bull market, and this is likely a correction that we've had off those highs a few months back, a correction in an ongoing bull market. So that formulates my longer term view. And if that's the case, what we've had here is a healthy correction. This is a drop in gold of about almost 20%, right down to what I refer to as solid support. Not only that, let's look at Fibonacci retracement levels. These are Fibonacci clusters, and what I've done here, these are Fibonacci retracement levels. If you're not familiar with what those are, I recommend a quick Google search. And what I've done is started out right here. This was the end of the last bear market that started in 2011 with the 2011 highs in gold. And that was December of 15. So that's a major level right there. If you're going to draw Fibonacci's, you want to start off there into the recent highs. That's what this purple line does. If you can see, hopefully you can make it out. There's little dash lines here. So I set that purple line at that low, and all these lines, there's yellow, purple, yellow, and blue, just to differentiate. They're all into the recent highs. So these are what they call Fibonacci clusters. Instead of just setting one Fibonacci line from the lows of the entire bull market, beginning of the bull market to the recent highs, I've set 3. I picked some major action lows, and I actually did this. I didn't want to busy the chart up too much for you guys, but I did them here too. There's a couple other reaction lows. And so what a Fibonacci cluster is, now I've turned off all the other levels so that it wouldn't look like a Christmas tree with too many lines. What you can see here, well, you probably can't see on the video, but I'm just going to walk you through, and you can replicate this on your chart. Each of these major reaction lows, again, going back here to the beginning of the bull market, this reaction low right here from looks like 2019 right there, early 2019, and there's 2 reaction lows here. I really like that. You have a reaction low from the fall of 2019 and early the spring, late spring of 2020 right there, right? 2 reaction lows. So those are your fibs. And right there, all 3 have a major Fibonacci retracement level. The key Fibonacci retracement levels are usually 38.2%, 50%, and 61.8. And right here, I can see the yellow line. So right here, that's a 50% retracement. Again, from this move to right here to the correction. 50% retracement. It is I got to really zoom in here, 61.8 in the purple line, and no, of course, that's the 32. The big purple line's your biggest move. That's the bull trend. So right in there, in their overlap, the 38.2% retracement of the entire bull run so far. 38.2, which by the way is usually the minimum, not always, but I like to see between 38.2 to 61.8 for what is considered just a counter trend move within a larger trend. That's so what I'm getting at is, so far, as painful as it is if you've been long gold mining positions and silver mining or the metals themselves, that is only a run-of-the-mill 38.2% pullback of a retracement, if you will, of the entire bull run so far from the late 2015 lows to the 2020 highs right there. And so that tells me, say what you want, and maybe it'll prove to be, maybe there's a lot more and the bull market's over, but right now it's a run-of-the-mill. And I really like the fact that you have not just really good price support there, but a cluster. Again, the 38.2% of the whole run. This is a 50% retracement of this move up from this major reaction low, and then the 61.8% retracement of that move right there. So there it is, Fibonacci cluster, which comes in with price support as well. So you don't always get positive divergence, is what I was trying to say. And and only time will tell, if we're in a larger bull market within gold, you want to be getting long on or around moves down to the 30 level. We never hit that on the weekly RSI, and that's, I would have preferred to see a full tag or a move below the 30 level on the RSI. I will say that. We came a little shy, but sometimes in a bull market, you come close and you don't get there. If we get another thrust down, and that's a possibility, we may continue to dance on these support levels for a while. And if so, you could see the RSI work its way down there. So again, something to watch, and I just wanted to explain my thought process on gold and why I thought there was an objective long there, even though we didn't have divergence. When I zoom down to the daily chart, I talk about whipsaws, or they've become increasingly common, it seems, in recent years. When I look at the daily chart, and there's the bottom of the, buy zone, this is support right here, about 158, and we hit it the other day, a couple weeks ago, I should say. But looking at these indicators, I could easily see, and I'm almost leaning that way right now, just looking at this and knowing how things tend to play out, another thrust down that takes us below there. And that's why I'm going to give it some room, at this point in time, some, room below my stops, because I was able to get in pretty tight there. And I could see another leg down and a nice flush out move, aka bear trap, false breakdown. They take gold down below 158 briefly. It's going to turn these indicators down, and if they can reverse it, and then your buy signal would be super aggressive to go long on a breakdown. I mean, technically speaking, or traditionally, you want to go short a break of support. What I'd be more favorable of is waiting for a recovery back above 158 if we get a breakdown. That's if. So if it looks like this, a little breakdown, it'd probably be impulsive. You'd see a lot of stops hit, in my opinion, a lot of selling. It could come down here. And then if you snap back and recover 158 soon, which would be my preferred scenario, if we go down and break it, it's going to put in positive divergence. Your indicator is going to look like this. The indicators should make, at that point, if it happens relatively soon, indicators would make higher highs, and that would give us positive divergence here on the daily chart. And as I like to say, fewer things in investing and trading are more bullish than a false breakdown, because what happens is shorts pile in here, and then if you reverse, you get that rut row moment where they realize, oh shoot, I shorted a break of 158, but the breakdown failed. It was a whipsaw signal, and they have to cover, and that gives you the catalyst, the fuel. Those shorts have short positions. They must be covered at some point, and the higher you go, they get squeezed out, and they're covering. When you cover a short, you're actually buying the stock. So you have both the bulls stepping in buying, and on top of that, you have shorts covering, which gives you additional buying pressure. And that again, it's a scenario. There are a lot of moving parts and very much micro calls, to that. But it's, again, something I'll be looking for, and I lay these out in advance. So if it starts to materialize, you know how to, what to look for and how to trade it. And that would be a downtrend line to watch as well. We're at that downtrend line now, so if you get it, boom, little move down, break recovery back above 158, and or the downtrend line would be quite bullish. Okay, and I lied. I said it wouldn't be a long video, so I'm just going to wrap it up here real quick with a update on crude. Crude hit the second target zone last week, bounced back a little above this first target zone, which was hit here. And I mentioned last week, I gave you a line right here. There's a reaction high there, a couple other reactions along this line, and we're at that resistance now. If we take that out, you still have a former support, now resistance level there, and an even bigger one at 63.76. So I still think there's more downside to come in crude, and I laid out some longer term potential targets. Hard to say for sure, but the odds will go up a lot better if and when last week's lows are taken out in crude. All right, long video. Again, I think went off on the gold. Probably spent a little more time than I'd planned to, but hopefully that lets you know where I think we're at and where we might, some of the different scenarios to look for in the coming weeks here. All right, we're going to wrap it up here, get the video out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.